In today's video, I'm going to address a number of things, but to start, I want to address one important concept when looking at the market, getting your emotions together and getting your thoughts together. Now, everyone wants to time the change in trend quite accurately. That's the goal. We always want to do that. However, today, we're seeing a change in trend. Does it mean that we do something? Well, in my opinion, you never put too much stock in one day. Something major can happen. The Fed can do a true pivot, and that is a notable thing, and that will certainly be reflected in the market in one day. And then you make adjustments. Today, there was no such catalyst. There was no such fundamental catalyst, and therefore, I think the longer-term trend is more important than one day and trying to extrapolate some sort of bottom and getting all imaginative with it. The market hadn't gone, or rather the NASDAQ hadn't gone 6 days consecutive, declining consecutively. The NASDAQ hadn't declined for 6 consecutive days since 2019. Yesterday, it went for 7. So we snapped that streak. But think about this. The entire sell-off this year, the second worst start to the year in history, we did not string together 6 consecutive days of decline for the NASDAQ, but we did until yesterday, and that just ended. Now, does that mean it's been washed out? We factored in the Fed, et cetera, et cetera, et cetera? I don't think so. And I find this quite frustrating, but nonetheless, we work with what we get. I don't know if you remember, but up until Jerome Powell had his Jackson Hole speech, the Fed would talk, say hawkish stuff. We'd come on this channel, say that was incredibly hawkish, fade the rally, and the market would go up. The Fed would be hawkish, and the market would go up. That literally happened twice today. We had 2 hawkish members repeat their hawkish rhetoric, say important things like, I'm not ready to say inflation has peaked. They're not ready to say inflation has peaked. They're not even at that stage yet. They're not even at the inflation has peaked stage yet. So, my opinion, based on judging this, is there is more to come. There's more hammering of the market by the Fed to come. The bond market is still pricing in rate cuts next year. Unlikely to happen. Unlikely to happen. If you're seeing what Michael Burry's tweeting, he's tweeting very valid points that inflation has done this thing where it spikes up and comes back down. But guess what? It spikes up again. If you look at the 70s and 80s, this is exactly what happened. And the Fed has reiterated on multiple instances that they are not going to let that happen. So there's only one way to not let that happen. Weaken the economy, slow growth, and keep rates higher for longer. The the bond market is not pricing in those 3 things to occur as they need to get inflation back down to 2% for a prolonged period of time. And if you look at the 2017 to early 2020 economy that we had, that the Fed keeps referencing, we had inflation at or below 2% virtually the entire time, and that was an incredibly prosperous time for the American worker. They gained very healthily. Wages went up in a healthy manner, unlike they are now. Unemployment was very low, and that was a Goldilocks economy. The Fed is trying to get back to that. There's one way, short-term pain. Because, let's not forget, the economy was strong through a tremendous event of virtual complete shutdown. So we should pat ourselves on the back for being able to hold it through that in the way we did. Yes, obviously, things were not great. But, damn, they were not as bad as they could have been. So we have to be thankful for that. And now we have to start paying our dues for avoiding such a catastrophic event. And hopefully this situation will be less catastrophic than COVID could have been. And I think it will be. I don't think this is going to be too terrible. But I think the over-speculation in the market, the aggressive pricing, the aggressive retail action is going to get washed out. As a matter of fact, we've seen retail participation go from roughly 24.5% to roughly 17 and change percent. That's back in line with historical averages. So we're going to see things come back to normal. We're going to see the level of speculation come back to normal. It's on its way. We're going to see the level of valuations come back to normal. They're on their way. Apple used to trade at 15. I think it's 15 to 20 is a reasonable valuation. I think 24 is a little rich. So I happen to maintain a short position in Apple. And the fact that I'm going to be definitely buying an iPhone 14 Pro the day it comes out does not change that outlook. It's merely a valuation. It's merely we're getting off the drugs type situation environment. So the market's rallying today. Bond yields are coming down today because energy prices are down. Well, I'm not so sure that if that's actually going to be a long-term proposition. I don't think the Fed thinks that's going to be a long-term proposition either. I think that's what they're concerned about. That's why they're not willing to call peak inflation. Zero hedge, we've talked about it on this channel. Don't want to get political. Obviously I do, but that's not the point of this channel. Anyways, we've been calling it the strategic midterm reserve. Why? Because it ends, it ends right before the midterms. We get all the benefits, the election happens, and then we don't get the benefits anymore. What it's been is the current administration has had bad energy policies that has led to a massive increase in energy prices. They've had to come up with an emergency solution to get energy prices down temporarily to avoid a shellacking in the election. Because I believe they knew before, but I guess they're learning again. Approval ratings and energy prices are very much correlated. So, strategic midterm reserve ends soon. We're getting an election soon. And it's going to be cold winter. So price might go up. OPEC's talking production cuts. China lockdowns, yes, that's certainly impacting the world today. That's a big part of it. But those will be lifted. So, fine. Energy will be down short term. We're ready to get back in come end of October type of time frame. If we get really attractive prices before then, in anticipation for future selling, whatever, we get panic, we'll step in earlier. We're not afraid to, we got the stomach at this point to take some time and experience some losses. So, to sum things up, don't extrapolate one day. Today's not the break of a trend. We had the longest NASDAQ losing streak since 2019. We hadn't experienced a 6-day streak since 2019. Yesterday was 7 days. The Fed has not changed their hawkish tone, and the market is doing just what it was doing before Fed Chair Powell spoke, moving up when the Fed is reiterating its hawkishness. The Fed doesn't like this. It shouldn't happen. And Powell will have to come back in at some point and lay down the hammer again. That's what's going to happen. Inflation, while it may come down, if you look at the 70s and 80s, it does the same thing. It spikes up big and it spikes down. And then everyone thinks it's cool when it's down. And then it spikes right back up because the Fed moves too quickly. The Fed knows this. They're saying higher for longer for a year. The bond market is not pricing this in. There's your edge. Okay? Call the bond market's bluff. Don't fight the Fed. Pretty straightforward. Energy prices, we know about the strategic midterm reserve. We know it ends right as the midterms begin. Fine. We'll give it 1 month, 2 months of depressed oil prices. We're already seeing OPEC cut. We're seeing Russia do its thing. Guess what? Towards the end of the year, we expect an energy rally. So that's going to bring inflation back up. We think that's part of the reason why the Fed is not willing to say inflation has peaked. All these forces, not so good. One day does not determine the trend. We'll see what happens. And until next time, peace out.